Welcome to Verticals, everyone. I am Nick. I'm in the VC seat, and we've got with us, as always, Luke in the founder CEO seat. And today we are super pumped up to talk about AI rollups. AI first rollups are pretty big and pretty recent craze in the venture world. Obviously, long-standing topic in PE broadly, but we're seeing more and more of these get funded by venture funds, and there's lots of different angles to it. So we're going to bring on Jeremy at Cabana, but before that, let's jump into the vertical pulse. And with that, I will kick it off today with actually a piece that we wrote over at Euclid called fittingly the AI first rollup. I think it's really important when we're talking about this, and Luke, please do jump in. But the big debate is really, does it make sense as a model, one, and does it make sense as something that is venture fundable, if you will, or is it a good use of venture dollars?
I'm excited for today. I'm as you know, I'm bullish on AI rollups, and we're gonna have a lot of good debate here because Nick has different views than me on this topic.
I wouldn't say I'm I mean, we'll get into it, but I think if any of you have read this piece, really kind of PE plays, if you can get more efficiency with AI, regardless of what you're rolling up, increase your EBITDA margins, that's multiple expansion for everyone. And I think we all know that AI can drive that sort of ROI. I think it is a bit TBD to what extent. I think the challenges and maybe why some folks call me a bit bearish, kind of stem from really the thought that you're building two different businesses. Essentially, you're building an operating business, whether it's lawn care or dentists, what have you, at the same time as you're trying to build an industry-leading technology product. And so I think the fundamental question is, somewhat we know how to do that in the startup land. Can we also run a industry-leading operating business at the same time? I think that's like the core of the challenge for me. Of course, as an early stage investor, there's also the question of dilution, right? If you're going to layer on $100 million in equity and maybe some debt on top of me as an early stage investor, well, does that make sense for my LPs?
I'm with you on these are highly complex businesses, right? And I think they are not businesses for first-time founders necessarily to chase, because you're building a software and AI company at the same time as you're operating a roofing business or a pool cleaning company like Jeremy, who's going to come on here shortly. So I'm totally aligned in the complexity here. I do think, though, that if you just zoom out a little bit and you think about this from the customer's shoes, right? The customer being who SaaS has sold into for, the last couple decades. The experience today is actually pretty horrible. Like, you have to use 35 different SaaS tools. You have to integrate them. You have to, a bunch of them don't actually integrate well or at all. And the reality is like the customer's sitting there and they're there to clean pools, or they're there to, I wrote a piece called The Laundromat Problem. Like, their whole job is to run the laundromat, and yet they find themselves like trying to pull all these tools together. And so if we could just talk from a utopia standpoint, if I had just asked one of those vendors, I think what they would tell me is they would ideally want one solution that does everything really well. And if that was a solution that they could build in-house because the operator had the core competency, I assume that business would be far more efficient, have far better margins, one that's trying to piecemeal together like 19 different SaaS apps. So look, do I think this is going to happen tomorrow? No, I don't. But if the technology race is real, is there a world where you don't need to have 25 SaaS vendors and you can build a lot of this stuff in-house tied to your specific workflows, and you have a really competent operator that can have a bunch of these and roll a bunch of these up? Like, there's going to be some incredible service businesses that can come out of this if they're done right. TBD, as you mentioned, but that's my view.
No, I mean, I think like the one area I agree with you the most is that, right now we have this opportunity to adopt AI throughout the entire economy. And, the presumption is, and we have early evidence of this, is that that's going to drive efficiency and productivity. And of course, economic benefits, greater multiples, whatever it is, right? Those businesses, let's call it lawn care businesses, they're not going to be the first adopters of AI, right? Like they've got more exigent things to worry about. This allows a competent operator to force that adoption, right? And so maybe there's an argument that speed just wins, right? If you can get AI into these businesses faster, then you're going to be the first to benefit from it. But let's move on to the next. But before we do that, the reason I popped this open, I just want to run quickly through kind of some of the pros and cons as I see them, and Luke later in. But just to kind of hit them lightning round style. Pros: bigger TAM, right? I mean, if you think about software, right, you're addressing a certain software budget. Now that may be changing as AI native software gets into services spend or headcount spend, but the AI first rollup, they get all the dollars from the lawn care services versus just the dollars lawn care services buying software would get. So bigger TAM, AI margin recapture, we talked about that. Acceleration of AI adoption, we talked about that. I think there's also less, maybe this is changing soon too, but less AI native or tech competent competition, right? I would imagine the other lawn care startups, Jeremy can tell us, are not thinking about AI as much, and then obviously capital appetite. It's popular right now. VCs are back in it, in addition to PE. Couple cons, just real quick, right? Running an operating business and a tech business at the same time and doing it well, that could be tough. Uncertainty around, kind of what the margin recapture is. I don't think there's proof points quite yet on, okay, well, can we take margins down or up rather 5%, 10%, double them? There's also the question of, do you build it in-house, or is the best move just to be the best AI systems integrator and just adopt the best tools that are out there, right? Which some folks are doing. And then, of course, dilution, as I mentioned, that's more from the VC perspective. But all right, let's get on my article and go to your next, Luke.
Yeah, for sure. So I really like this article. Matt Brown over at Matrix wrote it. He's a friend of both Nick and I believe. Really, really sharp guy, former operator. He broke this down, I thought, pretty well. A lot of the VCs have come out with their Substacks, right? But I really like just a couple of the themes he had. The first one I think I'll start with here is how he breaks these down, because everybody is just using the term AI rollups as a blanket statement, but in reality, there's a lot of different types. And so I thought he did a good job really segmenting them out, and I think the audience would enjoy it. So the first one he did is there's a lot of different flavors to AI rollup. So you have, in Matt's words, you have a crown jewel strategy, which is where you really just buy one probably pretty large business and you go all in on that particular asset and you AI enable it, in every way, shape, form that you possibly can. And so an example of this is Metropolis, right? So if you're not familiar with Metropolis, they were probably one of the first people to the AI roll-up party before it was even called that. They started with building a drive-in, drive-out computer vision technology where you could essentially, when you pull up to a parking lot, you got to take your card out, you got to put it in the machine, right? There's 5 cars behind you that somebody's honking. It's not a great experience. And so Metropolis' whole view was like, let's get rid of the gates. Let's get rid of the hard, these big kind of boxes, and let's just use computer vision, scan the license plate, send you how much it costs for how long you were parked there. So they started trying to sell this into parking lots. Really tricky GTM. I think it was pretty painful. This is a theme in a lot of these AI rollups is they say, man, what if we just own the business? We know this drives a lot of improvement for the business, but for whatever reason, this particular market, was challenged from an adoption standpoint. And so what they did in this crown jewel approach is they went out and bought SP Plus, which is this massive parking lot operator, largest player in the space, right? And so this is an example of they're not going out and buying 500, SMB mom and pop shops. Like they're going all in on one. I think that's smart. It's, less about integration and more about, nailing the one thing, that focusing on the one thing. It's smart. So that's one flavor. And Nick, I'm going to get through these flavors and I'm going to ask you which one you think, makes the most sense for founder out there or investor that's thinking about starting one of these or investing in one of these. The second one is what he calls the venture roll-up, which is more about going out and buying, a number of assets. So maybe you're going to go buy 50 or 100 or 20, right? Depending on the end industry, and you're going to improve all of those. So that's what he calls the venture roll up. That's where I see most of these businesses playing. Potentially more complicated than the crown jewel, but a lot less capital intensive, at least initially, right? Which is why most people are probably going down this path to begin with. And then he has the biz in the box, which we're going to have on the pod in a couple of weeks as well. Dan Friedman, who's the founder of Moxie, which, and we just had Alir, right? Alir is an example of a biz in a box. So it's almost this like reverse franchise model where you're not necessarily buying the asset, but you're giving them everything they need to start a services business, or you're giving them everything they need to operate one, but you're taking a you're not taking a traditional SaaS seats fee. Like in Alir's case at Slice, he's charging $2 for every single transaction, no matter how big or small it is. So a couple different flavors here. And I like how on the left side of the axis, he has, buy and run, high control, high concentration, high value capture, which is more on this crown jewel right next to it, and then followed by venture roll up and then biz in the box. And on the right side of the axis, he has build and sell, low control, low concentration, low value capture. So I think just a good way to frame this. Nick, what's your view on if you're investing in one of these or starting one of these, what's your approach?
I think those are two different answers, so I'll give them both. I mean, if you're a founder, all of these can work. I mean, obviously, crown jewel is a bit idiosyncratic, right? It's completely dependent. I mean, I think it may have made sense for Metropolis. I mean, but it's much closer to, merger or one-off acquisition than anything else. But I think like looking at the other two, venture roll-up, like, look, as a founder, I think it could make a ton of sense if that's the sort of business you want to build. I think as an investor, what attracts me most is the business in a box flavor. We, in some of our writing, we call this a synthetic roll-up, because I think what it allows you to do is get access to lots of fragmented operating businesses, much in the same way that a roll-up would. In some cases, even taking a percentage of revenue, right? Or accessing kind of those cash flows in some way rather than just a subscription fee. But you can leverage those, kind of individual businesses for distribution. So you don't have to buy them all. You can sell to them all. And so, if you look at a growth therapy, right? I mean, the business and box model has been very popular in healthcare. I mean, these things can just take off super quickly. Like we saw in the Leader Pod, you can offer more and more over time. And, I think it's just from an investor perspective, look, these can be much more capital efficient over time. And so that's my take, but smart people disagree.
We got Jeremy coming on in a couple minutes here. Let's do a quick lightning round. I know you wanted to pull together all the different roll-ups that are getting funded and what industries they're serving. So Nick had a good example of a recent one that GC just backed, I believe in the IT space. So I'll let you pull that up. And then I also just want to spend a couple minutes on all the different funds that have come out in support and all the different funds that have come out in opposition, because I think there's a big debate on and no real consensus yet on where people stand as when you look at the industry as a whole.
But I think, really, I wanted to pull up, not necessarily even to talk about, GC specifically or Titan, which is kind of the name of their holdco here. I mean, the backstory is, the GC raised a $1 or $2 billion fund, creation fund. A bunch of that is dedicated to AI rollups. One of their latest is focused on MSPs. So, these are like the IT shops that do IT help desk and, kind of project work on the IT side. I mean, I think the MSP space is super interesting and we could talk about that, but really I just wanted to bring this up because I think we're seeing it's a bit of inside baseball, I guess, on kind of just private equity industry at large. You're seeing these big platforms, GC, Thrive, and Andreessen launch products. And when I say products, I mean funds and new strategies that really ultimately look like PE. And I think it's it's maybe a natural evolution as AUM grows and, these start to take on elements of being asset management businesses. But I think it's pretty interesting to see because these players who, Luke, you and I think of as venture funds are playing in a space that 10 years ago would have been the exclusive domain of PE folks. So it's been an interesting interesting thing to watch in the industry.
Do you think these really look like PE funds, or do you think there's core almost innovation differences in a few areas, like 10-year hold, more of a venture timeline versus a 5? Can you actually provide real tech enablement and tech transformation in 10 versus 5? When you're doing multiple round dynamics versus PE coming in and doing it once, and then selling the asset in 5 years with no incremental cash in most cases. Like, I think people really try to put it in the PE box, but there are some, I think, real key structural differences here, even before we get into the technology, like just from a fundraise or just from a fund standpoint.
I mean, I guess do you think that with Creation Fund or any of these kind of new funds that are popping up, do you think that they are communicating a 10-year hold period? Because my guess is they're not.
Well, I know Thrive's a good example. Thrive just raised, they're doing it out of a holdco model.
Okay, yeah, holdco is definitely different. Which, look, that's not crazily new.
Just to wrap up the vertical market pulse, I want to quickly share my screen and show an article GC recently dropped. It's called "The Future of Services: Pioneering the AI-Enabled Rollup." I think our guest Jeremy may disagree with them because he was there before, but nonetheless, really first big institutional fund to go after this. I think it's helpful just for our market pulse to show some of the companies that are going after this. There's another website, I think it's rollups.fyi, that's actually tracking all of these real time, which is interesting. But you can see GC's doing a ton here. So they've got Crescendo, which they're buying call centers, implementing AI. They've got one in property management, legal. The legal services one is Udia. Long Lake, which a lot of folks have heard about. I think they've raised nearly $1 billion. That's Thrive and GC back. Titan, which recently got announced on the ISP side. And then a few stealth ones that coming out in accounting and a BPO and insurance. So a lot of activity from GC coming out right now.
I think it's also interesting to note here, they have about half of these that are incubated, right? And that obviously that kind of changes the profile of the deal a lot. Who knows exactly what they're starting out with, but I think incubation actually allows for a lot more flexibility in this model, even for early stage. Because if you start out with more, dilution isn't as bad. And in GC's case, they can fund.
Yeah, your cost basis is basically zero. Because I think these coming out of studios makes a lot of sense. And we've seen most of them come out of studios.
Yeah. Well, look, they may have to load in more cash up front, but, look, if they own 75% of the thing, that's a lot different than how do I make the deal work owning 10 or 20% and having to raise downstream capital. So yeah, I actually don't know for, like Crescendo or Vivera what the deal structures were, but it's interesting to see.
All right. Well, we got Jeremy knocking at the door. So that's our vertical market pulse. Let's get our vertical Titan for the weekend here and we'll dive into some playbooks. Sound good? All right. Well, we got Jeremy Yamaguchi joining us. Super excited. Jeremy and I have known each other for a long time. Both spent a lot of time together in Southern California. Jeremy is wicked smart. He's an incredible entrepreneur. He's built a couple companies, sold a couple companies, and he was very early to this whole AI roll-up game. That's what we're calling it. Nick and I were just joking that that's the blanket statement, even though there's a lot of different flavors to it, which I'm sure we'll hear about with you today. But Jeremy, if you don't mind just giving a quick background on you, on Cabana, on this business you're building. And then we want to dive right into a little bit of the story, but more so, the playbooks and what makes sense, buy versus build versus buy. What do you do first? What's your view of dilution? What's your view of funding sources here? It's a little bit of the Wild West, and it was really the Wild West when you got started on this a couple of years ago. So I'll turn it over to you.
Yeah, thanks, Luke. Good to see you and happy to be here. Good to meet you, Nick. By way of background, I'm a career entrepreneur. I've been building, scaling, and selling companies for functionally my entire adult life, but really have spent most of the last 15 years building at the intersection of home services and SaaS. Previously started, scaled, and sold a national brand in lawns. And with Cabana, we're building a tech-enabled roll-up in pool services. So we go buy legacy pool cleaning companies, we parachute in, professionalize operations, grow them organically, and then build vertical software into them to scale margins, build more of a competitive moat, drive kind of growth velocity and all that sort of stuff. So it is very much a kind of hybrid VC meets PE strategy. And as you mentioned, Luke, was, I think, thoroughly non-consensus about 2 years ago. And now is, as we're seeing kind of more and more funds adopt the model, starting to become quite a common bet, but happy to get into the merits and the trade-offs and the challenges of the model.
Awesome. Very cool. Well, let's start with, you sell your last business. It's software for home services, right? It was kind of the Uber for X-esque approach. You're taking some time off. You're thinking about what's next. How does this pop into your head, and why go all in on it?
Man, okay, I'll give you the shortest form of this answer that took me an 18-month sabbatical to arrive at. But post-exit, I asked myself all the many existential founder questions of, what journey is worthy of the next decade of your life? You know how tall the mountain is, so you don't have the benefit of naivete where you just put one foot in front of the other, and next thing you know, you're at base camp, and next thing you're halfway up, and then you're at the top. You know the slog, you know how tall it is, and so you tend to lens every opportunity through this question of like, is this worthy? Is it big enough, right? You want your next chapter to be grander and more momentous than the last, typically, right? I think it's pretty human nature to want to feel some sense of incremental or, exponential progress from one project to the next. And the problem with that is that most of the good ideas don't look like obvious billion-dollar opportunities, right? They're generally toys, the Paul Grahamism. They look like side projects that you just obsess about. And it turns out, airbeds and breakfast is this enormous opportunity, and a black taxi livery service to your rich friends in San Francisco turns into the logistics layer for physical space. So I just, after a lot of meandering and a bunch of side projects, I built a Gen AI company that used LLMs to read, summarize, and annotate the news, trying to reduce media bias across the various tribal lines. I built a marketplace for ADU building in California to try to address housing crisis and kind of shortage on the kind of real estate side. And ultimately just came back to, I didn't set out to be a home services guy, but I've spent a whole lot of time developing a very specific set of skills that afford me, I think, quite a few advantages building in this space. So I should play to my strengths. I should do what comes easy to me that other people find challenging. And so went back into home services, looked at every vertical, looked at lawns, pests, garage door repair, foundation repair, plumbing, electrical, you name it, and landed on pools mostly because it's pretty synonymous to lawns. It's small ticket, it's out of home, it's highly recurring, it's density driven, it's non-cyclical, goes through every macro environment, and it's massively fragmented, and there's no 800-pound gorilla and no national brand in the space. And we believe there should be a household name in pools. In the same way that, if you think about lawn care, you generally, TruGreen is like a public national player in lawns. You have Terminix on the pest control side, Rollins, Orkin on the pest control side. $30 billion companies in these industries. Doesn't exist in pools. And there's no law of nature that says there can't be. So the question was, how do you go about building this? Do you go marketplace model, kind of Uber style, where you glue together a bunch of independent contractors? Do you do an M&A kind of first strategy, which is ultimately where we landed? Do you build it all de novo or do something in between? So interrogated all that, landed on an M&A first model for a variety of reasons, but that is actually turns out not such a short answer to your short question.
So was the thought process, because at this time VCs aren't doing M&A models for the most part. Maybe there's some like e-commerce stuff happening with like Shopify aggregators, but really, as you mentioned, not consensus at all. How are you thinking about capital sources? Like, were you going to buy the first business with your own money? How did you, knowing that you're going to do M&A, like what's the next step?
Yeah, initial plan was to fund it myself and then maybe bring in a couple investors to have along the ride. And I went from wanting to build something relatively kind of localized to very quickly realizing that you don't find a lot of opportunities where you've spent a long time cultivating the exact skills that let you really swing for the fences in a space, and where you don't already, where the opportunity still exists, right? You look at most other home service categories, again, there's an 800-pound gorilla, there's already a large national brand sitting atop the industry, doesn't exist here, and I think we know how to build it. And so once I started getting really rigorous and built out a whole kind of investment thesis and wrote it all out, I realized I should probably try to build the biggest thing that I can in the space, given the synthesis of like timing and experience and opportunity all coming together. So that's kind of how I arrived at it. Funding wise, yeah. So I started raising capital and initially expected I'd probably have to raise mostly from non-traditional folks. your standard family offices, your high net worth types. And eventually, halfway through, ended up raising from quite a few VCs, but it was a mixed journey. Many of the VCs that we raised from invested personally in their capacity as a individual, but didn't do it through the funds because their LPs wouldn't get it. We smelt too much like PE to them. But I ultimately just came back to this, there are two arguments for why I think this model is a venture backable model. The first argument is, I guess, one from first principles, right? Like if you ask yourself what makes a bet a venture bet, I think it's three things. A, can you use venture dollars to grow at venture growth rates, right? B, can you build into an opportunity where if you're successful, the prize is like venture scale, the outcomes, you've built an IPO scale company worth many tens of billions of dollars. It matters for venture fund returns. You can return the fund many times over, sort of thing. And then C, are you using technology in some important way to expand operating performance, expand margins, grow quicker, build a competitive moat, and differentiate yourself in some way? And that is what we do, right? We buy companies for reasonable multiples. We grow very quickly. We're growing Cabana 4 times faster than I grew Lawn Love, which already grew very quickly. We're growing into a very large market. We think if we're successful, it's a many billion-dollar outcome. And we are building real software that doesn't exist in this industry to help provide an operating advantage and a durable, we think durable competitive advantage. So the fact that we buy businesses on day one instead of day 1,000 is frankly just a go-to-market detail, right? You look at most venture-backed companies that are somewhat mature and they do M&A all the time, right? Like Stripe probably buys 50 companies a year.
Yeah, but they're not buying services businesses, though. They're buying other tech companies, right?
Sure, but like that's just a question of, is your category good, right? Like, are you buying businesses that are, sufficiently homogenous that you can integrate them well? Or are you buying stuff that's totally unrelated? This was I think the failure with the Thrasio models is that they assumed any Amazon retailer was roughly similar in its supply chain. And if you buy a bunch of these like totally, dissimilar companies and you glue them together, you get these economies of scale. And that ended up not being true. There was mostly diseconomies of scale. And, they had other problems, right? Like over leveraged with variable interest rates and various other things that kind of nuke the model. But there are constraints. I don't think this model works in every business, but I think if you can find an industry where the businesses are largely homogenous and can integrate reasonably well, a pool is a pool, right? Like if we buy a pool cleaning company in Arizona, it's like functionally similar to a pool cleaning company in California. It's functionally similar to a pool cleaning company in Texas. So you can like reasonably integrate these into a standardized system and process and operating platform. And that lets you it makes the M&A growth vehicle a more viable one. But it does come with its challenges. Like I can talk at length about what's hard about the model. You're essentially building 3 businesses in one. You're building a legacy blue collar services business, complete with all the attendant challenges there. You're building a, M&A, high velocity M&A machine where you have to go source, diligence, underwrite, close, consummate all these deals. And then you're building a vertical SaaS company, right? But the beauty is you're not building vertical SaaS for some audience that you have to go like interrogate. What do they want? Why do they want it? Am I building into the abyss? You're building for your own discrete idiosyncratic problems. And, that makes it quite a bit easier. And you have no, sales motion. You have no churn. You're just building for yourself.
I think it might be helpful for me and for the audience, if let's kind of maybe walk through the actual model. Cause I think, one thing that's probably different from, for a lot of the founders listening is, the perpetual M&A. So like, let's say, doesn't have to be Cabana, but a similar tech-enabled roll-up strategy raises $10 million. How does that break down in terms of, okay, we're going to put that into X number of companies. Those companies put off X amount of cash. And I guess what I'm getting at is, can it be self-funded, or how much downstream capital do you need?
Yeah, I think that's one of the beauties of the model. You know this well, but venture is so cyclical, and we go through these swings where it's like, capital is roughly functionally free, and the only constraint is how fast are you growing. No one ever cares about profit margins and unit economics and all that stuff. And then you'll get through a crunch, and everyone's talking about profitability and how they don't actually need subsequent capital, and all the capital intensive startups die or don't get funded. This bet is very capital efficient because we are buying cash flows for some reasonable multiple, right? Like 2 to 5 times cash flow. And then we're recycling those cash flows to buy more cash flows and to invest in R&D. So really all you need, if you have a light holdco team, we're pretty much a holdco model. We have a team up top that does the growth marketing and product and software development and M&A. And then we have the OpCo below it that runs the businesses, and we integrate all the companies we buy into the OpCo. If your holdco, the OpCos are profitable by definition because you're buying profitable companies for multiples on their profits, right? The holdco, it has a burn, but if you can buy enough revenue and grow your businesses organically and expand margins, you pretty quickly cover your holdco burn. So, we've raised a total of $10 million. We've been net profitable on the holdco level a year in. We only recently stepped into a burn rate again because we ramped up expenditures on R&D and kind of product development. But that's very intentional. It's very capital efficient. You can build we think, IPO scale company with, maybe 20 million, 30 million in total venture raised.
That's different than because it seems like everyone else is going out with $100 million raise, like to start. And obviously, I don't think you had the market wasn't ready for you to be able to do that on day one, but I haven't heard anybody say that they can get that big with that little of cash.
I guess help me understand it, because when I think about it, let's say $10 million in, right, and that buys you $5 million in revenue on companies you acquire, which is maybe what, $2 million in bottom line EBITDA you get from that a year, and you're growing obviously, but so it's okay, 10 million in capital gets you $2 million in cash. So how is that self-sustaining?
The economics are quite a bit better in our business. $10 million get us probably 15 million, 12 to 15 million in revenue, and 4+ million in EBITDA. So, compared to SaaS, that's incredible kind of revenue per dollar efficiency. And again, you're spitting cash. So obviously a function of multiples, obviously a function of how good you are at M&A. Can you actually run and operate these businesses effectively? If I were a new entrepreneur thinking about getting into this model, I would ask myself, I would think about it in terms of risk buckets, right? You have to de-risk the series of things in this business. The first is, can you go buy companies at reasonable multiples, right? Can you convince sellers to sell to you on terms that are, workable and market clearing? 2, can you actually integrate these companies well? Integrating in many cases is harder than acquisitions. It's not that hard to convince people to take millions of dollars for their business. It's convince teams that maybe did not want to be acquired and customers that maybe did not want to be acquired to cut over. So can you integrate well is kind of bucket number 2. Can you run these durably and better long term? Can you expand margins? Can you centralize back office? Can you, use economies of scale to drive operating leverage and so forth? And then can you grow them organically? And lastly, can you build vertical SaaS to empower and kind of accelerate and enable all of, the first 4 things? M&A velocity, margin performance, growth velocity, and so forth. So what order you do it in, I think it depends mostly on where you think the biggest risk is. If you're not good at building software, you should probably start with the software to make sure you can actually do that. And there's a there. If you're not good at M&A or you have no experience, and that's a critical ingredient in the model, you should probably make sure you can buy some stuff first, because you can build all the SaaS until the cows come home to roost. But if the only businesses you find are 20x EBITDA, you're toast, right? So a lot of it has to do with the industry, our specific kind of, off-market proprietary deal-making machine, and a combination of a variety of those factors. But
what kind of growth rates are you underwriting to that you think you can actually juice on the business? And then are you also underwriting to basically the classic PE, valuation arbitrage as you scale, right? So if you're buying them at 3 to 5, is it an important industry characteristic that continues to grow as the company gets bigger? Some industries, it's 5x, whether you're big or small. So, a lot of them, it's as you get bigger, the multiples continue to step up. And is there an even higher multiple that gets introduced for these AI-enabled companies that are run by technology entrepreneurs?
Yeah, it seems like most bets historically in home services have been this assumption that with sufficient SaaS, Wall Street's going to value you as something closer to a technology company than a services business. And we don't really care about that. If that happens, obviously we'd be even more valuable. But our model is basically, can we buy these things for 3 to 4 times EBITDA? At scale, we have dozens and dozens of examples of scaled home services platforms across pest and lawn and arbor care and plumbing and mechanical and handyman that trade for north of 20x EBITDA multiples. So, and this is post 2021 prices. This is kind of modern prices. Roland's public company, pest control, trades for a 32x EBITDA multiple today. not some like goofy private equity valuation where they sold it into fund 4 from fund 5, right? Like an actual public company with no SaaS. So like there are very large businesses that trade on very healthy multiples in this industry. And so like purely the multiples arbitrage is a massive value creation machine, right? Like you're buying things for 3 to 4 times, you're selling them for long-term in the teens to 20s. Then you grow them organically, right? You expand the size of kind of that EBITDA through organic growth, and you improve the margin profile of the business. You're both growing like numerator and denominator. It's like a pretty powerful machine. Obviously, if one day people look at this and say, "Oh, you're really a technology company. You're Uber, right? You're not a taxi service. You're a genuine technology company." Then you're on like revenue multiples, and like it's a totally different game. But like we think probably we just get valued at high EBITDA multiples, and you're still like creating an enormously valuable enterprise through this strategy. It doesn't have to be like venture pixie dust all the way up. Like you could eventually switch to growth equity or, private equity valuations or public market valuations at some point. Ultimately, right, like we're all valued by the discounts of our long-term cash flows. But I think the thesis is not that we're going to sustain this venture style valuation forever. I don't think we need to.
So Nick's in the VC seat, right? He's got his own fund. He hears a lot of the AI roll-up-esque pitches. I think one of the concerns I hear from Nick and from other investors is the dilution aspect here as you fold in companies. Nick, do you want to give like a couple concerns you have about the model and let's see kind of how Jeremy thinks about that in the inverse?
Yeah, for sure. And, caveat with these obviously may not all apply to Cabana specifically, right? This is, totally generalizing, but I guess the trade-off in my mind is like, look, we at Euclid as an example, right? We invest honestly at inception. We invest super early. We get the vast majority of our, stake and upside in that company in that first round. And so every single dollar that comes in certainly after seed or Series A is dilutive to us. And we recognize every business has to raise some downstream capital, but you can imagine a scenario in which a company wants to eat up the industry really fast. They're going to have to go out and raise a bunch of equity on top of us. That's not ideal necessarily, right? So I think for me, it's just this trade-off of you definitely can run these more profitably and self-sustaining, as you mentioned, right? But do you then lose out on this speed to that multiple expansion? Because like, as you mentioned, Rollins, great multiples, but they do 3.5 billion in top line, right? So like, how long is it going to take to get there if you're kind of constrained on growth because you're self-funding your own acquisitions?
I think it's a fair question. I do think, like you've mentioned, I've actually generally had the opposite problem when pitching VC, is that, this, but many firms are pretty interested in deploying the largest amounts, the largest checks. It's, possible.
Management fees, baby. Management fees.
They're playing the AUM fee game, and so they have to write large checks. And in many cases, like we're not a good fit for them because we're too capital efficient, right? You are, again, unlike most venture bets where you are, investing in a company that is in search of a business model and is, more or less throwing cash into an incinerator in search of PMF and escape velocity. And you hope that they find it and get there before diluting to smithereens and having to raise like 5 rounds of funding in the process. Here, you have a profitable business on day one, and you are only turning it unprofitable to the degree that you want to invest in R&D up top. But today, like it doesn't take that many heads to build a working SaaS product in a good industry. It just takes the right people. And so for relatively few R&D dollars, you can build the technology leverage that you need to execute the strategy. And so it's not actually, it's like extremely capital efficient. Now, why all of these accounting roll-ups raise $100 million on day one is probably more a question of like, does General Catalyst write $10 million check? And the answer is not really. And so that's probably mostly why they do it, is you can. But I don't think you have to. To your question of can you move fast enough, I can just say that our model has us getting to IPO scale in 10 years, and that's, fine for most venture horizons. Are we going to do it in 2 on, $20, $30 million in total venture raise? No. But if we can do it in like 8 to 10, I think that's still like very, 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 very good returns. And most VCs would write that check.
And the asset is like in comparison to some technology companies, the core asset is pretty liquid the entire way through, right? You don't have to prove much because you've got cash flowing from day one. Now, you may not get the multiples you want if you sell too early, but I think from a founder perspective, again, if that's the sort of business you want to build, like I think it can make a ton of sense. I think my argument really stems from, does it make sense for, an early stage VC fund in which my LPs are looking for, 5, 10, 20x, net return potential. I think GC is look, I mean, don't get me wrong, incredible investors, very smart people, but when you're putting tens of billions to work,
Yeah, the calculus is different.
Yeah, exactly. So I think that makes a ton of sense.
Yeah, I appreciate that. I think, again, it's pretty capital efficient on day one. That's just how I think about it. So if you're worried about dilution, this is probably a model that minimizes it. And if we did choose to, go raise a couple $100 million to go do some massive acquisitions, you would only do that if you are very clear that this is just an enormous unlock and creates a ton of enterprise value. And then, yeah, your relative ownership of the company shrinks, but your price per share skyrockets and your returns ultimately are better. So I think everyone's still happy in that scenario. Companies do badly when they need money and are not doing well, right? And so if you are doing really well and you have lots of cash and you opportunistically go raise enormous sums of money to go accelerate what's working, this is kind of like the point of those venture dollars being available, right? And I think most people would be happy for that. Most early stage investors and LPs would be happy for that scenario, if and only if you're doing it by choice and opportunistically as opposed to out of necessity. We're not Boom Arrow. We're not building Concords. Like, we don't need $3 billion to get an MVP to market, right? We can use lots of money to move faster, but I think we can move pretty fast on our current steam. And that's, I guess, one of the advantages. One of the way that I characterize this is it's basically a venture style bet on the upside, in that if it works, hopefully, multi-deca billion-dollar company, PE downside protection. So if it doesn't work, you have a basket of cash flowing assets that trade at, liquid market multiples that are presumably larger than what you paid for them. And so there's a certain class of investor that's wants to preserve capital. I think if you're Andreessen Horowitz, you're like, I don't care about the 3Xs or the 2Xs. I just care about not missing the next 100X or 1000X. And so for them, saying, hey, there's a pretty good chance at a 10X or better, and a very good chance at a 2 to 3X, very, very good chance. They're like, the 2 to 3X probability being so high is actually probably a downside for me, because you might find a happy liquidity event at a $300 million exit, and that doesn't move the needle on a $4 billion venture fund. So, maybe the fact that this is such a good model for shareholders and early stage VCs and common shareholders, it makes it a bad model for the moonshot farmers and the people who have to write huge checks and only are investing in the $100 billion outcomes.
Exactly. I mean, Andreessen, if they're raising a $20 billion fund, they may not be the ideal example, but yeah, I mean, I think there's a reason why the sort of model we invest against works, which is we don't need that much capital to get exposure, theoretically, if we're doing our job right, to the companies that 10% stake is going to 3, 4, 5, whatever X our fund. And so I think that's the thing, is your bar is not all of the, 50% fall into the loss ratio bucket, or 20% or 70%. It's that top 2 or 3 companies in your portfolio, which are all that matters, in which, they're going to grow 3X year over year and, go all the way or get taken out at 50X revenue.
It's a bit of a weird argument though, right? Because we're basically saying this business is so good that it's valuable all the way up to IPO, right? At all stages, it's there's a market for it and it could sell and it's valuable. I would venture or I'd stipulate that that's true for your best SaaS companies too. Your best SaaS companies are spitting cash, probably only raising, opportunistically. They really there's a company that I remember clearly in our YC batch way back in, the yesteryears of 2014, called Checker, run by Daniel Yanessi, right? Background checks, I'm sure you've heard of them. They were profitable on demo day, and to my understanding, never once were not profitable. They raised hundreds of millions of dollars, but they just did it to accelerate. But at every point, kind of just kept it in the bank. Now, one could ask, why would you do this if you don't need the money? And I think that's a fair question, and I'd be curious to hear Daniel's answer. But it, like, that business was, I suppose, also exposed to the risk that at any point they could have sold it for like infinite life-changing money from a founder and kind of common shareholder perspective. And this may have presented a risk from the VC's perspective. But that is basically true, I think, for any really high-quality business. Unless you're like Uber and you're just burning capital as a club to gain market share and you are committing to a path that's like infinitely, capital intensive. Yeah, then you can't ever sell that thing until you go public with it. But most businesses aren't like that, and that presents its own series of problems. You'd probably argue that this makes it too dilutive because they raised $10 billion before IPO. So I don't know. I think your argument makes sense, and also think that it's like a bit of a catch-22 where your business is too good, therefore you might exit early, but you kind of want to invest in great businesses that always have that potential as an investor, in my opinion.
Yeah, I mean, I think it really all just comes back around to growth potential, right? Like if the difference in impact on IRR is so huge between a company growing 2x and 10x year over year that regardless of whether or not it's profitable, like you will go with the 10x growing company and like worry about that later as an early stage investor. And so, yeah, I think like it's really all chips in on if you're growing that fast, I don't care if you're burning a ton of money, if you go out early, you'll get taken out a huge multiple. Jeremy, if you don't mind, I wanted to ask a question I'm really curious about. When you think about technology in your business, what is the incentive to build something in-house versus just be kind of the best systems integrator and just not even worry about the R&D spend, just pick and choose and integrate the best?
Yeah, we've thought about this a lot, actually. I can only answer from our industry and kind of given the existing options on the landscape. You might, if you're rolling up something where there are really good off-the-shelf third-party solutions, your calculus might be different. But in pools, there are a handful of vertical SaaS providers. Almost all of them are built for like what we would call mom and pop, single polars, chuck in a truck types.
This is like Skimmer,
Brain, like Ion. There's a number of these guys out there. They're really built for like the smaller, localized company use case. None of them have built good tools for scaled operations that are running in multiple verticals or even multiple markets. And you're at best you're getting the meat and potatoes of what you need. You're getting some basic CRM, you're getting route optimization, you're getting scheduling, you're getting billing. But I wrote the first 300,000 lines of code at Lawmove for our backend kind of field service software stack and hired an army of engineers who wrote millions of lines behind me. And what we learned there is there are so many, it's like standard Pareto stuff. Like you can get 80% of it with the basic kind of field operations, kind of routing, logistics, billing features. But the 20% where you're gluing together workflows and not having to use, you're having to use humans to like make systems talk to each other that aren't optimized. And if you're building vertical SaaS for a generic pool guy, you're going to pick very different features and you're going to build those tools very differently than if you're building vertical SaaS for a hypergrowth M&A powered roll-up machine. And so our belief is our application is so specific and our needs are so specific that there is no solution in the marketplace that comes close to serving our needs. And we're also pretty good at building software. And so just buying stuff off the shelf would be, to some degree, shredding that opportunity. So we leverage those advantages to go build our own custom tools because we think we can get to like 90-95% optimization as opposed to the 70-80% we'd get off the shelf with some third-party solution. If your industry was different and the stuff off the shelf was really 95% of the way there, then like, God bless. Like you probably should buy, not build. But if that isn't true in our case, no one's built tools for businesses that look like ours. And so we kind of, out of necessity, are happily building it.
How much is off the shelf versus built in-house from day one to today to where you see it going in the future? And how should a founder think about? There's a ton of debate, as you know, about this whole buy then build or build then buy. And my philosophy is like if you can raise the capital with a pitch deck because you're a badass entrepreneur and maybe you already dominated this industry, then you're typically buying and then you're building. A lot of people need to prove some sort of EBITDA uplift thesis to be able to raise capital to go buy an asset. So I'm just curious how you thought about that, how it looks in your business today, how it looked on day one and then how you see it looking in the future.
Yeah, in our case, we very much wanted to buy first because, to my earlier advice, that was the highest risk bucket for us. Is like, can we buy these businesses at reasonable multiples? And, can we get them off market? Can we convince sellers to part with their life's work in our direction at prices that make sense for us? And the answer to that is now, a year and 9 months in, a pretty clear yes. But we did that first just to like de-risk it and make sure we weren't running down some, false path. The benefit of that approach is that it also gives you more or less a kind of like, you can use this company as the bootloader for your vertical SaaS, right? Instead of having to like build software into a speculative dimension of like, what might I need when I go buy this future company? You don't really know what you're going to need until you're in the company and you're running it with the tools that came with the company, and you see exactly how those tools fall short. And so I think in general, you have a lot of advantages to buying first if you can afford it and you can, fund it, and then using the learnings of operating with existing solutions to go inform what you then have to go build. So we built on day one a bunch of like conversion stuff. We built a, kind of a computer vision model that looks at satellite imagery and figures out if you have a pool in your backyard, and then measures the dimensions and triangulates the depths and estimates the gallons. And we can give you a quote sight unseen without having to physically send someone out to look at your pool. Didn't exist in the market, was an enormous kind of uplift for lead gen on day one. We built that right out of the gate. The rest of it, like the whole system of record, back office software, we've been running on, and still to this day are running on the tools that came with the companies that we bought while we go build our own backend platform. And we deliberately took like 12 months before committing to that path because we wanted to be very right and not, go spend a bunch of time and energy hiring an engineering org to go build a bunch of products that we could have trivially replicated by buying off the shelf for fractions of the cost, right? So that's how we skin this particular cat.
How, Jeremy, like, would it ever make sense to you to sell that software to non-owned trades in your space?
We've thought about.
Metropolis has done this. They're selling their software and they're also buying up, parking lot operators.
Yeah, we've thought about it. Metropolis, first and foremost, was a SaaS company that sold fast and had that like kind of whole motion already and go to market already. And then they bought stuff because it, vertically integrating made sense. I think in our case, we're pretty committed to not doing that because for two reasons. This is, I guess, my second argument on why I think the tech-enabled roll-up model makes sense, is that it allows you to unlock a vertical SaaS playbook in industries that maybe are not well suited to traditional vSaaS go-to-markets. And a good example of this is pools, right? Like if you look at most service categories, gyms, massage parlors, hair salons, there's usually like Mind Body. There's an 800-pound gorilla. They're public, they're huge, or they're public scale that has already kind of won the vertical SaaS game in that industry. And you could maybe look at this and say, Service Titan in home services is obviously the big one. You can maybe look at them and say, oh, well, they're pretty good in plumbing and HVAC, but they're not great in this other vertical to kind of not go for this narrow use case, and we can go build a specialized solution here. But pools, I don't think are a great candidate for a venture-backed SaaS rollout or traditional venture-backed SaaS model, mostly because it's super fragmented. So there's 72,000 pool cleaning companies. The average pool cleaning company does like $130,000 a year of revenue. So you're really going to have to go rabbit hunt all of these subscale operators and like chase them down to clip $50 a month in SaaS subscription revenue. Your churn's going to...
The CAC is upside down.
Your CAC to LTV ratio is going to be totally warped, right? Like your churn's going to be sky high because these guys go out of business at 20% a year to go get real jobs, right? Like it's a tough industry to tackle with a traditional vSaaS model. If you instead buy some of them, use them as the bootloader to build vertical SaaS, and instead of clipping $50 a month, you capture the full economics that your product provides. And finally, like all of that upside falls directly to your bottom line. That, as a secondary prize, makes you a much better M&A machine. Because if I have a proprietary tool set that I can use to reliably and consistently expand the margins of the companies I acquire, I become the obvious buyer of choice for every quality asset that comes to market. Because no one can pay as much as I can for your business if they can't perform as well while operating your business. And that's the long-term goal and kind of thesis behind it, is you don't just make your cash flows better and accelerate multiple expansion and margin expansion and stuff like this. You also create the obvious acquirer of choice for the best businesses in the industry.
I mean, I might slightly disagree there. I mean, I agree with you. Some markets are just structurally hard, but like there are plenty of big vertical software business that has been built in highly fragmented markets. I mean, Luke, we talked with one of them in Slice in our last episode, but I mean, look at Jobber. I mean, look, they're a little bit maybe more horizontal across a couple of trades, but like that's a, sub 10K ACV business that's going to be really big. So I think there is some element of like maybe the right form factor just hasn't been tried yet. The right founder just hasn't come along. And there are probably some markets too, like you said, Jeremy, that are just structurally tough. And it sounds like maybe Pool fits that bill. But yeah, I think it's just an interesting question, right? Because it sounds like in your market, it's pretty blue ocean in terms of SaaS, which kind of makes that a little bit attractive to maybe say at least give them something, if not the full picture. But maybe it's a distraction.
Yeah, I mean, I would argue Jobber is a horizontal market, much like House Call Pro or Service Titan, and they're usually they're used across a lot of different verticals, so their TAM is a bit bigger than Pool's.
Certainly not as strategic. I would say though, look, if you have a market where you have over 50,000 buyers, I mean, if they're average 100K revenue, then okay, maybe you have to do some math there. But I mean, I just mentioned Roofer is going to come on the pod in a couple episodes. Like that's another market, like 100,000 locations, and maybe the revenue is a little bit higher, which makes that easier. But I think it's just a question of where you can get your ACV credibly over time. Because I think you're right if your ACV is like absolutely capped at a couple grand, but if you see a path to do that kind of synthetic roll-up business in a box, like we'll get more and more of the business and we'll get up to 25K ACV, then it looks interesting.
Where I get really excited about this model is in industries that are SaaS graveyards. Like I experienced this, there's a lot of industries where you have company after company that has died trying to sell into the space, whether it's an ACV issue or the go-to-market. You can try everything inside, outside, product-led, marketing-led, partnership-led, blah, blah, blah. And it's still a country club. It's still 24 months to like prove your reputation and work with lobbyists. There's a bunch of these. Like in trade schools, it was where I built and sold my last company. Go-to-market was brutal, man. It was tough. Now, fortunately, our ACVs were $100,000 plus, but and so if you can find a market that has a SaaS graveyard where people have just tried to buy and sell, software, and the only dominant players have really been through some sort of like private equity hodgepodge, like SaaS roll up, I think this is a really compelling opportunity.
Yeah, we haven't talked about AI roll ups at all, and I think this is like one of the central theses behind why AI rollups make sense. In particular, Luke, is I'm sure you guys saw this MIT study from last week that 95% of all big corporate kind of pilots have failed. And one of the leading causes of that failure was more or less like it's too hard to do the change management institutionally and internally in these businesses, right? Like there's too much resistance in the employee base to shockingly disambiguate themselves from all their jobs, right? So not disambiguate, like divorce themselves from their jobs. So like I think one of the theories here is instead of having to go to a group of people who are reticent to adopt your technology that's going to probably reduce their headcount, you just build a competitor or you buy them, and now you can force use of the technology because it's your company, right? And I think YC sings this song a lot with a lot of the recent funded startups is we're going to fund AI for anything that already exists, but we think the legacy players are going to be slow to adopt it. And we've seen generally technology curves. There's a massive, kind of lagging tail. And we as technologists and founders live at the cutting edge of most adoption cycles. And I think probably overestimate the degree to which most people find this, these new tools to be welcoming and fun and, exciting, excited about them. But I think, buying a company gives you an advantage that, simply selling into companies often does not.
Yeah. I mean, I think the most exciting thing about it to me is, Jeremy, businesses like Cabana are, excel, whether or not you're AI for it or not, right? You're accelerating the adoption of technology, and it's going to be a net good. I mean, hope obviously a big net good for Cabana, but like just for the entire economy, right? This is, I don't know how we feel about the efficient markets theory these days, but like you're doing the hard work to get people warmed up to this technology and get AI out there, and that's got to be good for everyone.
I would agree with that. And thank you, Nick. You know, you take an industry that has much of this leverage and you apply the leverage to the benefit of both the field service workers, your pros, your techs in the field, and to the customer experience. And, hopefully you're creating net value for the economy. I think demonstrably you should be. Technology is the only reason we're not scrabbling in caves for food every day. Like, that's the default state of human existence. So the degree to which you can apply technology to industries that haven't yet enjoyed it is like advancing the human condition in some very direct way.
We may have a few techno optimists on the call today. Well, Jeremy's got a day job that he's probably got to get back to, but I got one final question. I'm sure, and I think Nick has one final question too. I'm just curious if before you came on, Nick and I were kind of debating this, which is the existing world of the service businesses that every vertical SaaS company and horizontal SaaS company has sold into for multiple decades. Like, if you just look at it from a core customer level, which we fail to do far too often, it kind of sucks. Like, you've got 20 SaaS tools, half of them don't integrate, half of them were bought by Constellation, and they're just like cash sucking profit machines with no resources behind them. And the people, if you were to ask them, they'd probably say, I just want like one really good tool that does everything that I need it to do. And it's simple and it's straightforward. Like that would be utopia, I think, for 99% of service businesses. So my question is, like, if you fast forward 10 years, is all the software being built inside a service business and the VSaaS ecosystem is really from the business, it's built inside the business and it comes from that direction? Or do you see it more like there's real clear monopolies on the software and AI side where we have like one AI super agent for pool cleaning and that's what everybody uses to get the stuff done? Or are we in a similar ecosystem where we're in today where we're using, what the average company in SaaS sprawl is using 20 tools?
Yeah, I think if I'm like apply Lindy principles to the question, I assume the future will actually look a lot like the past, which is big companies will be highly incentivized to build their own tools because their needs are going to be unique and not very well serviced by off-the-shelf solutions. And they will have the resources and capabilities to go build those tools. And small companies who want to be in the business of cleaning pools and occasionally talking to their customers will very happily give you a lot of money to help solve the, I get to schedule and bill and do all the back office stuff. So their needs are not that complex. Their needs are not that unique. Their needs are quite similar. And so for those players, I don't think every, plumber, HVAC company like spins up their own software practice, even if it's pretty easy with AI. I think we, again, as technologists, underestimate the degree to which prompting your way to a vibe-coded app is still pretty intimidating for a lot of people. And we look at this and we say, this is like unbelievably accessible. You've just rendered the production of software roughly free. Like, how does everyone not just build infinite tools? And the answer is because they just don't think like engineers and they don't know that they can even solve these problems. It's like they miss the questions, not necessarily the solutions. People can present solutions all day long, but they just don't even know what questions to ask. So big companies that have more software DNA and know how to ask questions are probably going to solve more of their solutions internally as software gets cheaper and cheaper to build. Your run-of-the-mill mom and pop is going to continue to happily pay $60 a month for you to do this for them.
Last question. I talk with a handful of founders thinking around, tech-enabled or AI-first roll-ups, I'd say a week. And I'd love to get your help in guiding them. You mentioned earlier, Jeremy, you feel like you're running kind of three businesses in one, right? Operating roll-up tech. Could you stack rank how difficult those are? Like, what should a founder going in expect?
A question that is unique to my own, skills and position. It depends on what they find easy, but building the software is easy for me. Like, thinking through how to solve problems and design kind of elegant, intuitive workflows for users is kind of comes naturally. It's in the DNA. Growth marketing and kind of SEO, SEM. I've lived and breathed this for 20 years. That comes easy. Running a blue collar business and running a blue collar services business with a bunch of folks who, some of them are incredible, and you essentially inherit teams, right? You didn't go and hire all these people, one by one and interview them. You inherited a company with a bunch of pre-existing teams. And in many cases, you inherit absolute gems and wonderful, incredible people that are additive. But sometimes you inherit people that you probably wouldn't have hired. And so how do you navigate that in a world where, it's again, blue collar? I often will say that lawns and pools and roofing are kind of like the last bastion of felons. Like if you have a record, there's a finite number of places you can get a job. These are outside of people's homes. You can have like, you can be a bit of a character and still do well in these industries. And so you attract a lot of characters. And so running these human services businesses with a bunch of characters, many of whom you didn't hire, but you inherited, and doing that at scale with systems that you're building on the fly is unambiguously the hardest part of the business. The M&A piece is like hard, but if you're good at sales, if you're a good founder that can raise a bunch of money, you're probably reasonable at sales. You'll be able to like buy people's companies. Like you're able to tell a good story. You're able to like build camaraderie. You're able to, help them want to partner with you and not some, random person. That I think is less hard than I thought it would be. And it's the running of the field service business and the operations and all the, the bits moving through, the atoms moving through space, not the bits, is much harder.
Awesome, man. Well, Jeremy, thank you for being here. You're a legend. I appreciate it. I'm excited to see what you're going to build. I think it's going to be a massive, massive success. And you were early to the party as you usually are with these things. I bet if you look back a few years, it probably wasn't in the cards, or at least you probably didn't expect it. I sure didn't, that there would be multiple multi-billion-dollar funds dedicated to this strategy. So it's been fun to watch just the last 24 months.
Not at all. Yeah, I was planning on like trolling the outer reaches of family offices for sources of capital. I might have had to launch a token or something like that to succeed. Now there's committed capital that understands the model intimately and likes what we do, so it should be easier.
Cabana token dropping next week. Thank you so much, Jeremy.
Good chatting, Nick and Luke.
Thanks, man.
All right, that was Jeremy from Cabana. Awesome conversation. I think we'll all be super tuned to tracking how they do and how this AI first roll-up market continues to grow. I think with that, huge thank you for joining us today. Obviously you guys are a big part of what we're doing here at Verticals, and a huge thank you to Paraffin for making it happen. If you guys haven't checked out Paraffin, please do, but they're the lifeblood of the Verticals show. We'll see you next week, and thanks for joining us.
Thanks, everybody. See you next week.